So today's topic, folks, we are talking about 2021 tax filing. It is really meant for do it yourself. So if you're interested in filing this year's taxes on your own, these are key matters you want to know to yourself, because of course, I know everybody know how to file tax. They just buy a software, plug in the number, and it just magically the tax return is done. But it's not as simple as that. The application of where to put that number, anticipation of what number should come out, that's really the knowledge, that's the basis. So what I am telling you right now in this session is just to give you that basis. So you got a feeling, you got you get a temperature on your skin, knowing that this tax return you're doing is right or wrong. Even if you hire professionals to do your tax return, nothing wrong with knowing it, so that you can post that smart questions and say, hey, did you do that? And that would give you a better chance to have your tax return done more accurately. Now let's dive into it. Do it yourself. 2021 tax filing, things you must know. Okay, absolutely. And please take everything on internet with a grain of salt, because your situation might be different, and because my knowledge could be outdated. And of course, I try not to be that way, but I still say that it is important to do your own judgment and don't just quote somebody somewhere on the internet. IRS don't even buy it. Let's say if you get audited and you say, well, because this is internet proof, I did the research, this is what internet said, so I did that. IRS don't buy it, because internet sources, the only reliable sources on internet is irs.gov, is the government site, but not anybody, and not communitycpa.com, even though we try to be a good steward for the knowledge, because we are a CPA firm. So we actually do study, we have a librarian at the firm, we have people who does research to make ourselves more knowledgeable and to make ourselves qualified to service you, right? All right, so let's run to the content. And I have about 20 points I want to make with you, and some of them you will be immediately attached to it because you knew what I'm talking about. But sometimes my point a little far away from you because you haven't really come across that situation. No worries, you just hear it, because hearing it will bring it up for you when you at the moment need that knowledge. But if you never heard of it, you would never pull it out. So hearing itself, it is already 50% of learning. You don't have to literally be the expert. You can just be the one that heard, and that would already help, right? All right, so the first slide is actually related to capital gain. So there's a lot of people, I'm telling you, a lot of people are doing stock market trading. So a lot of them are coming through wanting to know mark-to-market, election, and the things that are related to that, right? So a lot of times the struggle is between the tax rate, because when you have, there's two types of tax rate, right? One is income tax, the other one is capital gain tax rate. They're different. And look at this, long-term capital gain tax rate. I listed 2021 because we're doing taxes for 2021 now, folks, right? And I also give you reference to the future, which is 2022, if that is already set in stone. And I also will tell you about 2020, okay? So you kind of know that, you know, you're filing 2021 tax return, but you kind of want to know what's going on right now. We're in 2022, right? So I'll give you that. And this capital gain tax rate, the long-term capital gain tax rate has three rates. Basically, the highest rate is 20%, okay? The lowest rate is 0%. So in what case, when you have a long-term capital gain, you pay 0%. So look at my chart here. So that's a tax filing status. Let's say I'm single, just yin. And my taxable income, my W-2 income is $40,000. Then I had $5,000 long-term capital gain. And then in this case, I apply for 0% rate. Actually, this taxable income, remember, it needs to include your capital gain, okay? My example is not perfect. Let me redo my example. I have a W-2 for $30,000, and I have a long-term capital gain for $10,000. So my total taxable income is what? $40,000, right? And I'm single. I'm not single, but I mean, if I am single, and taxable income of up to $40,400, that is 0%. That means my $10,000 long-term capital gain is free of charge. Am I right? So this is what that means. So that's what I'm telling those day traders. If you have an account that is a long-term capital gain, because you hold stock for more than a year and you don't sell them frequently, and you should not turn that into mark-to-market. You should leave that account as a regular capital gain investment account. All right, so 2021 rate is still that way, no change from 2020. The only change is they increased the taxable income by a little bit to adjust the inflation, but the ballpark is the same, 0%, 15%, 20%, depends on how much income you are making. But in 2022, let's look at this year. See, there's still three rates, 0, 15, 20, no change, okay? So just a little bit of adjustment on the income level to adjust for inflation for 2022. So that says what? That says day traders, if you have a long-term capital gain portfolios in one account, and you have your short-term on the other account, when you do mark-to-market, don't touch your long-term capital gain, okay? Because they enjoy the lower rate. So next slide is about short-term. Of course, capital gain is short-term, long-term. So short-term just means that you turn around, you sold the asset or your stock and things like that faster within a year. So they become a short-term. When you have a short-term capital gain, you are using regular income tax rate. They're no longer those lowered 0 to 20% rate. You see, the tax rate goes from 10, 12, 22, all the way to 37. So if your income is total $500,000, you're already paying 37% on anything above that. So let's just example. Let's say my W-2 is 400,000, okay? And I made short-term capital gain of 100,000. So my short-term capital gain, that 100,000, will be added together with my W-2, pay the tax rate on top bracket is 37%. So this rate just means that they cut up your income into different tiers. So each tier was a different rate, right? So a lot of times when I meet clients talk about tax rate, and I always talk about effective rate because I chunk them together. So let's say if you made about $70,000 a year on income, then your average tax rate is about 20%, because I chunk the 10 to 22% in together for you so that you got an average rate. So those are easier thinking. When we talk about taxes, those are shortcuts that you would have when you work with professionals. People like myself deal with taxes all the time. So we don't, we understand it's a graduate rate, but when we explain to you, we will be trunking them together for you with a simple rate. So that's a short-term capital gain in 2021 rate. So you can see that if you're single and you make anything under 40,000, and if your capital, let's say they're all short-term capital gains, then you pay 12%. Okay, so that is where I want to bring this up, just because this capital rate versus income tax rate is a very big confusion in the day trader community, and the people thinking that, okay, mark to market, I will deduct all my losses, but you also know that mark to market will make you pay regular income tax rate versus your capital gain tax rate. If your capital gain is long term, then you'll be losing out a lot, because 20% is much less than 37%, right? So this 2021 rate, then you also have 2022 rate. I bring up the 2022 rate just for you to get a feel. It's not much of a difference. So see, it is still $500,000 on the top rate. All right, so this couple slides, I kind of summarized with you the related to the day trading, related to the stock market work, okay? And one important information I gave you, which is outside of that slide, is to say that when you do mark-to-market election, you know you don't have to do the election for all of your trading account. You can pick and choose. So you can pick the short-term one for mark-to-market because they're taxed on regular rate anyway, but you can leave your long-term be the capital investment. So always subject to the lower income tax, lower capital gain rate, which is the same for 2022. All right. Now, let's talk about section 199A, 199A. When I talk to people, I call them real accountant. When they talk to me goes, well, what about my section 199A? And I regard them as real accountant. But I don't regard them as a real human because what is section 199A? That's just so confusing. And what that essentially is actually a business income deduction. So section 199A just represents the section of the tax code says that the qualified business income deduction can be 20%. That's what it says. So in 2021, it is still the same. This is the thing that President Trump brought to the business when he was going through the Job Act in 2018. So that is new at that time. So it's coming along, and 2021, we still have the same thing. 2022 is where the President Biden come on board. A lot of things are meant to be changed. You know, that's what president do. I think it's almost like inaugurations. That's just part of the things they do. They come on, become a president, then they mess up all the tax code, and making the tax accountant have a new job again. So that's, you know, on one hand, we say, that sucks. On the other hand, we say, well, that's fine. Let's keep our jobs secure. So you guys always have to come in to our webinar and listen to us. You know, I was going to use that BS word, but no, let's not use that word. It just, you have to listen to us and what to tell you and to update your knowledge. It's all good. So the section 199A applies to the following entities I want you to know. Number one is sole proprietorship. You know what that is, right? The Schedule C. If you have a Schedule C, say you have a sole proprietorship business, cleaning homes and stuff, that's a Schedule C and applies to that. That means, let's say you made $100,000 net profit. The tax allow you to reduce that to 80. So you don't have to, 20% of that, you don't have to pay taxes. It's called qualified business income deduction. Just off the top, take 20% off, right? And the partners in partnership, that's 1065. Shareholders in S Corp, that's 1120S. And the members of an LLC. So if you're LLC and are making business income, and the beneficial owners of a trust and estate. So there are the kind of trusts that will produce income, and then you may be the child of the very well-doing entrepreneur. So you got that K1, and then you qualify for that. So these are the entity you can take the 20% off the top, right? And these entities can deduct 20%. That 20% deduction happens in 1040. So on your individual tax return. So let's say you take to your tax preparer a K1, and you didn't know, you forgot about section 199A. You just know there's something Ying talked about, 20% deduction. So you can just ask your tax preparer, can you just tell me where is that 20% reduction to my business income, and where did that show? So you're supposed to see your business income got reduced by 20%. All right. So of course, if you are too wealthy, and you can't take that. So it's subject to limitation of your taxable income under your 1040. So for joint return, for a spouse, for a joint return, you and your spouse, and if your total income is over 329,800, forget it. You don't get that 20%. And if you are a single filer, 164,900. So basically, if you make too much, don't get it. And if you're not making too much, and then you have the 20%. Isn't that good? Right? So sometimes, those slides, behind this simple slides, what I am thinking is tax strategy. So sometimes in your business, and you grow your business, so your children get involved, and maybe it is time to start moving the ownership into the children, because they will not have AGI. They will not have taxable income over 164,900. Then what that mean? The portion they take, they can take off 20% off, right? So there every rules out there. And for the tax accountant, there is an implementation of efficiency, tax efficiency behind it. So that's why rule exists, is for the smarter ones to take advantage of. That's why President Trump only pays $700 some taxes. Okay, look at the size of his business, and get some clue, right? So the next slide is also very interesting. So business meal deduction. Have you heard business owner cries about they cannot deduct the meals anymore in 2020? So that's also Trump's good doing, okay? Trump put out this Job Act, eliminated all the entertainment and meals. What I was thinking at the time is that he must be getting enough of deduction already in his lifetime, so he doesn't want any other business owner to get it anymore. So he just put out, goes, no more. And that changed. That changed in 2021. So look at the table. So type of expenses: entertaining clients, concert, sporting event. No. So 2020, Trump took it out. 2021, and Biden didn't make any changes. So still says no deductible. So don't take me, even though you love me so much and like my webinars, but don't take me to concert. Don't take me to sport event. I don't even like sports. So, so I never have those kind of, interest. So you don't need to worry about your accountant. But your business partner, don't take them there because it's not deductible. But look at next one: business meals at entertainment venues. And in 2020, you can only deduct 20 or 50%. But in 2021, did you see something about 100%? Yes, 100%. So let's say if I went to a sport event, hypothetically, if I'm at a sport event and I bought these meals for everybody I work with, and 100% deductible. All right. So business meal with clients, it used to be 50%. Okay. Now it is 100% in 2021. All right. And office snacks and meals, 100%, used to be 50%. That was the one that really, caught my attention in 2020, because you know how, tax offices, CPA firms like our firm, during the tax season, who has time to even go out? So everybody is literally camped in the office, right? So the office would have snacks, meals, and for people to be around. And that in 2020 is 50% deduction, but in 2021, 100%. So folks, if you're running a business and you bought those things, now no hesitation, is 100% deductible. Company-wide party, yay, that can get wild. Company-wide party, 100% deductible. Meal and entertainment provided to employees, 100% deductible. All right. So in 2022, right now, in our time, same in 2021. So the same rule applies. Don't go party too hard, okay? COVID is not done yet. And, I was sick for like a week and a half. So I missed out 2 webinars, but then I tested negative. I really don't know, but I think I got something even worse than COVID. So I wonder I should give like a COVID power or some sort of a double COVID, a nickname for this kind of cold that you can never shake. And I still have a little bit of coughing sensation like right in my throat. So I don't, if you think my voice is weird today, and that's because of that. But anyway, COVID is still here. No party, folks. Okay. And, but I want to tell you something. If you are superstitious like me, and I believe history repeats. Okay. So 100 years ago, Spanish flu, on the third year in the winter, it got rampant again. That's 100 years ago. And everybody got sick, but the death rate is lower. And then spring comes, is mysteriously gone. The virus just gone. And nobody knows what happened. Life went to normal. So I bet this spring comes, the virus will mysteriously be gone and the life go back to normal. So if you're in business, be ready. Be ready for a big scale in business, okay? And that is something I'm just glad that I can tell you. That's what I'm thinking. I'm overly optimistic a lot of times. Okay, this is a really good one too. NOL. What is NOL? NOL stands for net operating loss. So it's a business loss in your business. So let's say you make $10 income, you have $30 expenses. So your NOL is $20. Make sense? 10 minus 30, 20, right? Okay. Excess business loss and net operating loss. So-called excess business loss is the same as net operating loss, just means that your losses, your business expenses are greater than income. So you got more losses than income. In 2021, it's very different from 2020, okay? If you had loss in 2020, the game is very different. You can carry back your losses to 5 years from before. So let's say you had $100,000 loss in 2020, okay? Loss. So you take this 100,000, you go back to 19, 18, 17, 16, and 15 to look for the year that you had 100,000 gain. Then you offset that gain, get the tax refund from the prior year. So that is to tell you that in 2020, the gain was different. So you had that treatment. Whatever you didn't claim, let's say you offset prior 5 years, but you still have more left. Then you carry forward to the future, no limitation until you use it up. Okay, so that's 2020. But in 2021, the rule changed. So generally, the rules give a what we call the floor. And in 2021, the threshold for net operating loss is 262,000 or 524,000 in case of joint returns. So if you are a single filer, you have the maximum net operating loss you can claim in 2021 is 262,000. And in joint return, it's 524,000. And it's limited to 80% of your income. So means that you can never make your AGI zero. You cannot make yourself zero. You have to pay some taxes. So 80% of taxable income, you can use that to offset the loss, but not 100% like 2020. Okay. And no more carry back. You cannot go backwards anymore in 2021. All right. But you can carry forward indefinitely until it's used up. So this is a big change for NOL. And if you felt like it's kind of going over your head and it's not relating to you, don't worry. That just means you're not in that situation. But you might be in that situation if you're a day trader and you had a lot of losses and you did an MTM election, okay? And you might be that in that situation if you closed your business in 2021 and you had a lot of losses. And you might be in that situation if you partner with somebody and that partnership is completely flunked and you just lost everything. Okay, so whatever happened in 2021, if you felt like you're looking at the negative number, then you think about this slide because it will help you to get your taxes back now or the future. All right, now let's go to the next slide. So this NOL is very useful, folks. So I always tell our business owners that there's no such a thing about losing money in business. As long as you continue going. Of course, if you lose money and you shut down and you're no longer touching that, maybe that is a loss, is absolute loss to you. But otherwise, it is a musical note and just goes around because you have a loss in this year. Next year, you have a gain, you offset the loss. So the loss is almost like a little deposit bank for you to find the future gain so you don't pay taxes. So don't look at your net operating loss, absolutely negative, and find that silver lining when you are in the not so good situation. And if you're really closing your business, felt completely down, and there's no other hopes you felt like can really help you, and I would not mind you come to Community CPA to talk to us to see whether you have other options. Okay, don't give up. And there is nothing in business can be really labeled as loss. All right, so you received PPP forgiveness. This is something that I really want to make sure you know. Maybe you did not receive PPP, but your friend did, and or your spouse's business has, and making sure you did not add that amount into your income. So important. So if you got the PPP forgiveness, let me just give you the journal entry, because this is, if you are, a little bit accountant, you'll know what I'm doing. But if this journal entry make you throwing up, and then you just remember I said that PPP forgiveness is not taxable. So it is like grandma's mason jar money for you, and don't tell anybody and just keep in the pocket. All right. Of course, the government already knows, so it's not like that's a secret. No, people knows how much PPP everyone gets. It's a public information. So if you got a PPP forgived, and your journal entry should be the bank, you got $100,000 PPP, so your bank deposit increase, right? And the other leg is not your income. It is actually your equity. So you can put that on additional paid-in capital as a 100,000. So it's not in the income. It is also not a reversal to your expense. So don't include that in the gross income, and don't reduce your payroll expense. And because you got paid by PPP, expenses are still expense. They are not gone. Don't take it away because you got a PPP. Okay, leave it there. And what else is like PPP? There's a couple of more things are like PPP. And the EIDL advance. If you got that advance, that one is not taxable. So it's like a PPP, it's a grandma mason jar money. Okay. And then RRF, that's grandma mason jar money. And then you have other state give you grants. Maybe you're in California and who knows where you are. And your state grants will tell you whether it's taxable or not. Don't just include it in the income and watch. Okay, read, figure out first before you do it. Okay, all right. So that's a really important point. If you want to do it yourself, how could you not know that? You have to. And especially some of the PPP money was coming from Schedule C. Remember, Schedule C filers also got a PPP. Hey, don't add that back into Schedule C. That is literally not on your book. You don't have to report it, okay? All right. So the next one I want to talk about is a standard mileage rate. So I literally clipped it out of IRS website. Remember I said the only reliable information you got is IRS website. So IRS give us already made announcement for 2021. So 2021 is, they already made announcement in 2022. What am I thinking? 2022 is per mileage, per mile is 58.5 cents. Okay, it's 2.5 cents more than 2021, and 18 cents for medical. All right, and 14 cents for non-charitable organization service. So that one didn't change, but the other one, they all kind of raised by a little bit, right? The business one raised by 2.5 cents, then the other one raised by 2 cents. So now when you prepare your tax document for filing taxes, and make sure you use the new, you use the 2021 rate for the 2021. Don't get yourself confused with what's rate today, because we're talking about 2022, right? And 2021 rate is 56 cents, 16 cents, and 14 cents. So I put that out there so you use that. And of course, I know there's a bunch of questions related to, wow, should I do mileage deduction or I should do actual? Just that alone is going to be a new talk. It's going to be a one webinar to talk about that. But let me tell you that if you are in business, and I would highly recommend you to use actual to take your car into the business as a business asset, and do not do standard mileage deduction, because this kind of deduction, when you get audited, is so hard to prove, and you are doing it right. And I had recently done an audit for a real estate agent. I mean, I think the agent has done fabulous job in the mileage. She tracks every trip she has, and she does, you know, writings. But then she changed the car. In the 2 years she get audited, she changed 3 times of her car. And that change kind of messed up on the mileage. Then she has to run around to go get odometer readings, and it's just impossible to get that justified. So in the end, the IRS, you know, cut off some of the mileage deducted, and just not pleasant. And really, you can never satisfy IRS on that. And if you could stay away from mileage, standard mileage, and just run your, you know, purchase your vehicle under your business name, make it a business property, and be a business asset, then you don't have to bother with the mileage, you know, calculation. All right, so that's that on the mileage. Okay, the man, we still have like 8 points left. Okay, so let's make sure we are not late for our time. So this is net investment income tax. This is a new tax, folks. I don't know whether you noticed that we had this tax since 2017. Okay, and if you didn't really make a lot of money, you probably didn't come out to see this one, or maybe it's getting calculated in your software you didn't even know. Folks, if you're going to do it yourself, you better know there is a 3.8% additional income tax. Okay, and that additional income tax is this way. It's applied to individual. Basically, it's a 1040 tax. Okay, trust, estate, you know, let's not bother with them. And then most of you may not have that situation, but if you do, it will naturally apply. So the net investment income, I give you a couple of examples. Because this 3.8% is applied to net investment income. So what are they? Their interest, their dividends, their annuities, their rents. They are the passive income, okay? And they apply for that, or, okay, not both, but or access of modified AGI over the following. So if you are married, filed jointly, you have more than $250,000 AGI, and then your net investment income tax will apply. And if you are married, filed separately, 125,000, and you know, individual. I am so sorry. I told you I still have this super COVID. It's not COVID, but it's something. Oh, by the way, I use this. I use this for cough. My favorite. I'm pretty sure you use that too. I just got from Walgreens. All right. So the net investment income tax, the reason I bring it up here is for you to know that they are applied to the passive income, or when your income is too high and above that threshold, you will have it. You don't have, if you use software, you don't have to worry. It will calculate for you. But just in case you're wondering why you're paying more taxes, that would come. All right. So know that existed. So in 2021, there is a higher standard deduction. So it's $12,550 for single filer. Okay, and $18,800 for head of household, $25,100 for for family, for a couple. And of course, if you're over 65 years old, you put in your age in the system, it will give you that $1,350 more. And if you're head of household, it will give you that extra. So you can always rely on standard deduction. But if you do itemize, like you put in your medical expenses and all that, then this doesn't increase. You can't really be adding this together with your itemized deduction. So you either have itemized or you have standard. Okay, just know that if you are a head of household, or if you are older than 65, you actually got more. So don't just tell your tax preparer that no, I'm going to itemize. I have this and that expenses. You let your tax preparer to decide which one is higher for you. So then you choose that one. Okay. All right. Then our next one is medical expense deduction. You know how when you have medical expenses, when they are over 7.5% of your total earning AGI, right? They're over your AGI. Let's say your AGI is 100,000, 7.5, that's $7,500. If your out of pocket is more than that, you can deduct that. You will deduct that out of your Schedule A. So this is the situation where you do itemized deduction, right? So in 2021, it came back down to 7.5%. It used to be 10%. So this is just to say that if you got $10,000 medical expenses while your AGY is 100, then you actually can deduct about 2,500 right there. Okay. But of course, when I say deduction, it is itemized deduction. So it's together inside of Schedule A. You still want to make sure that the standard, if 25,100, it is still higher, then you still use this one. Okay. All right. For student loan, and this is something I want to mention. If normally when you get a loan forgiveness, I'm not talking about PPP. I'm talking about mortgage loan, whatever loan, forgiveness. When you have that, and you normally would include that in your income because forgiveness of loan is taxable income. But the student loan that you are forgiven is not taxable. All right. You don't even include that on your tax return. So it's grandma mason jar money. So if you got forgiven, and it's not taxable. So now folks know that the student loan relief is extended to May 1st of 2022. So you don't need to pay any student loans until May 1st. So between now and May 1st, and you should work on getting that forgiven. Okay, that would be a work you need to do. So of course, not everybody qualifies for it, but try it because the program is out there. All right. So that is what I want to mention to you. And then CTC, child tax credit. So in 2020, is per child is 2,000, but in 2021, and there's slight changes, okay? And the 3,000 per child, and that is 17 and under. So that including the age 17. So 3,000. Then you also have a kids younger than 5, that is 3,600. And remember last year, starting from July, some of our folks already received the advanced payment for CTC. So when you file the taxes for 2021, make sure you put the amount of advanced in the tax return so you don't get to claim the full amount, because otherwise your tax return is wrong. The IRS is pretty good at knowing who got the advance. So don't forget to report that, okay? The credit, when I say these credits are fully reimbursable, what I mean by that is even though you didn't pay any taxes, you still get that 3,000. You still get that 3,600, okay? So to receive this child tax credit, you must be having income less than that amount, 75,000 for single and 150,000 for joint. All right. All right. So our we have 3 more to go. So required minimum distribution. This is for elderly. You know, if you are older than 72, you know that your retirement fund has to be coming out. Like they require you to distribute. They don't allow you to save it for your heirs. So but in 2020, remember, you don't have to do that. So there is a 1-year break for that from CARES Act. So that is restored. So 2021, you must. So just knowing that in 2021, and you should have minimum distribution, you should have 1099-R that gives you that amount. Then you're supposed to report that on your tax return. You say that, well, I didn't have that in 2020. Well, yeah, 2020 and 2021 are not the same. Okay, so of course, in 2022, right now, it's the same. It requires minimum distribution. Okay, so that's that one. Charitable contribution. So this one is really interesting. And I want to make sure there's 2 places to put charitable donations, right, in your 1040. If you are going to do your taxes on your own, and you want to know that you want to put your charitable donation outside of Schedule A for 1, then inside of Schedule A you can do it more. So you can get 300 charitable deduction even though you don't itemize, means even though you don't file Schedule A. So take the 300 charitable donation, come out to fill that out on the first page of the 1040, but don't go into Schedule A. And for single filers, 300. If you're a couple, that's a 600, right? And the CARES Act allow you to contribute up to your total income. Let's say you have AGF 100,000 and you can contribute 100,000, and then your Schedule A will show up like 100,000. Then you can deduct it all. You don't even need to pay any taxes. But in 2021, and that CARES Act requirement goes on to the end of 2021, which means that right now, when we file 2021, you can still do that for CARES Act, but 2022, this year, no more. Okay, so just remember, let's say if you make a W-2 for 40,000, okay, you have a job, and you also, you know, wanting to support this nonprofit, you're going to donate 40,000 all to the nonprofit. In 2021, you can still do that. But in 2022, you cannot, okay? Because 2021 is still allow you to zero out your income. So 40,000 minus 40,000, you make no money, you pay no taxes. But in 2022, right now, it's not there anymore, okay? So that's a charitable contribution piece I want to mention to you. And in 2021, the corporation may deduct charitable, I didn't really do my word right. Gift, GIFT, up to 25% of taxable income. So that they're limited to 25% of their income. So my last piece, but not the least, okay, it is to just briefly mention about gift tax. So the estate, these are for folks who passed away in 2021. If someone died in 2021, I think who died in 2021, that's really famous. I know that baseball star, Brian, I just forgot his name, in California. He had a helicopter accident. So in his case, and he can exempt for $11.58 million in estate. Otherwise, the estate will pay 40% taxes on whatever he had left over. Okay, of course, there's other things to do to not pay that taxes, but I just want you to know that this means the worth of the person when they die. Okay, what is more related to regular human is the gift exclusion, which is the 15,000 per recipient. This is the same as last year. So 15,000 means that, let's say I am a parent. I give this kid 15,000 is my children, right? So I can give 15,000. I don't need to file gift tax return. But let's say if I decide to give 1.5 million, then I need to file gift tax return because I am the one giving to the child. So I'm the one filing the gift tax return. Okay. So in another word, if you stay within this arena and there would be no gift tax return to be filed, that should be okay. All right. So that concludes our 20 points from beginning to the end. And our last slide is just the information that where you can find us. So during the tax season officially started, right? Officially started. So in our office, this is how our community CPA works in this particular tax season. Trust me, we've been changing rules every year because the pandemic never show up the same. So this year, and we encourage people to getting onto our portal to upload their tax document or email their tax document or drop off their tax document. And we do not want people to stay in the office lining up. And that is not healthy. And given the fact that, last week, one of the branch in Bloomington, everybody was sick from flu, some COVID, some not, it's just a mess. So for that reason, and we want to make sure that we try to Zoom meet and we try to drop off document, avoid face-to-face, person-in-person contact still for this one last tax season. I'm pretty sure in 2022, when we go into 2023, and it would not be the case because Spanish flu lasted for 3 years. I expected this one just about to get done. So that's kind of how we work. Once we received all your document, and we will be scanning. If you drop it off, we scan, we upload that to your portal so you can see what we have. And then we will prepare your return. Normally, if we got everything, we prepare, our process is 10 days, 10 working days. So that means about 2 weeks, right? So in 10 working days, the tax return will be done. So we will meet on Zoom, most preference on Zoom to go through the tax return with you. And then you can e-sign and we can e-file and you can e-pay. So it's all done with a big letter E, okay? Hopefully, we'll run this smoothly. And I hope that throughout the pandemic, every one of you, every one of the business owner has a lot of questions related to pandemic government funding treatment. I kind of touched on it with these slides, with this webinar, and just really think deeper with that. If you have questions you don't really know, and if you always did your tax return yourself, and this year is the year that the do it yourself DIY is not working, and then you can consider to work with Community CPA. And we do want to make sure that whether you work with us or not, we want to make sure you have the knowledge to process your return accurately. So important. It's not worth of doing it wrong, then get audited. It is a whole lot of nightmare to endure if you do that. So let's do it right from get-go, and then life would be simpler, right? All right. I hope I have brought to you good information. And if you have any questions, and contact Catherine at communitycpa.com, and we'll get back to you. All right. Sorry for my cough, but we got through. Okay, bye-bye.